You won't believe how hard it just got to get a new mortgage in Canada. Interest rates have dropped over the past 12 months, but for self-employed people in Canada, it might not be as easy as you think. In today's video, we're going to talk about what is happening right now with mortgages in Canada in 2025. And I'm bringing back Jesse Merson to the channel. He's my personal mortgage broker, someone I very much rely on and an expert in this space. So Jesse, welcome back. First of all, how are you? And thank you for doing this again.
Hey, Tom, great to see you. I am fantastic. Thanks for having me back. I appreciate it. I'm excited to be back and chat with you again today.
And just to clarify, you're coming on this video, but then the trade-off is you're going to show me how to grow a beard after?
Right.
Okay.
No problem. We'll do a separate video on that. Absolutely.
Just want to make sure we are clear on that. Okay, so there's kind of three main topics I want to talk about in this conversation and let you kind of lead the way here. Let's just start with rates. You know, fixed rate, variable rate are very similar right now. Yeah. Just general thought on where rates are at, what you're seeing people take on renewals and purchasing new properties. You know, what's the day-to-day looking like for you right now?
Yeah, so in the last couple of weeks, fixed rates have gone up just a touch. The inflation number last week, core inflation was well above 3%. And so that's above the Bank of Canada's target. So that's a concern. And so that has driven bond yields up, which drives fixed rates up a little bit. In addition to that, on the variable side, what we started to see is lenders decrease the discount from prime. So with the variable closed mortgage, you start at mortgage prime minus a discount equals your interest rate. We've seen that tighten up a little bit as well. Obviously, the undercurrent being tariffs and whatnot, lenders are also adding a little bit of a risk premium to their mortgage rates just because they really don't know how things are going to play out, not only in the next few weeks, but in the next few months. Some of the banks' earnings calls have happened recently. They're boosting their loan loss provisions. One way to generate some money to offset that really is through charging a little bit more on the mortgage rate side. Having said that, historically, mortgage rates are still in a very affordable spot. They're still in a decent spot overall. I think we just got so caught up with the rock bottom rates of the pandemic that, some of us sort of thought, okay, this could be normal for a little while. It's not normal. Those were not normal interest rates. If you look at mortgage rates that are available today versus prior to the pandemic and those prior 10, 15 years, we're very close to where we were before. So overall, I think rates are in a decent spot. We'll just have to wait and see how things play out.
Somebody asked me the other day if more of my clients were taking fixed or variable. And I was like, I don't know. I'm not having that conversation with them. They're speaking with the mortgage broker or the bank. So right now, is it still the trend is most people are taking that maybe 3-year fixed or 5-year fixed product?
Yeah, for sure. The 3-year fixed, I'd say hands down, number one choice. The 5-year fixed is also quite popular. The variable is entering the conversation. The variable is an attractive option, just considering where rates could potentially go. But 3-year fixed, hands down, I think is the sweet spot for most people right now.
And for people that are maybe watching this video, but you're not fully in the weeds of how this all works, for potential first-time home buyers watching this that don't have that 20% down payment, can you tell me why? Because this is always something funny. It's like, when you put down less than 20% and you have an insured mortgage, your rate could actually be lower.
Correct. That's right. So if you put down less than 20%, lenders do have mortgage rates that are on average about 0.2% lower than their conventional mortgage rates. So a conventional mortgage rate would be somebody puts down 20% or more. High ratio, sort of industry jargon, would be anybody that puts down less than 20%. Therefore, your mortgage is insured by CMHC, for example. You do get access to slightly lower interest rates, both on the fixed rate side, as well as a slightly larger discount from prime on the variable side. Mm-hmm. So it can save you a little bit of money there on the rate side. The other basket of mortgages that are available out there, which are available at other mortgage providers, not banks, would be what we call insurable mortgages. So nothing to do with CMHC, that's insured. I'm talking about insurable mortgages. If your home is worth less than $1 million and your mortgage represents less than 65% of that value, you qualify for an insurable rate. And these would be available at a number of mortgage providers across the country, credit unions and the like. And typically these rates are very similar to your CMHC insured rates. So if you fit that basket, even if you're thinking, you know what, my home is maybe worth a little bit more than $1 million today, if you bought it in the prior few years for less than $1 million and you have that purchase agreement still, and we can verify that, you would fit into that insurable basket. So that would be something to, take a look at. And that's something that I'm always talking to my clients about, especially for all of my clients here in Toronto who have a condo. A lot of those types of mortgages fit that basket.
I learned something new every day. I had no clue that was an option for you. That's really interesting. On the mortgage rate talk, okay, 12 months ago, mortgage rates on the fixed rate on the 3 or 5 year were in the 5.5%. Now they are in the low 4s, some under 4, not a lot under 4, but depending on the situation. But low 4s range is kind of what we're seeing. So over the last 12 really to 18 months, we've seen like mortgage rates drop pretty significantly. And in that period of time, that means that the true cost on a monthly basis of buying property is lower purely based on having a lower mortgage rate. But I'm very well aware that there are many people watching this saying like, well, the market hasn't bottomed yet, and I don't want to buy until we see that prices are ticking up a little bit. I'd rather take the risk and pay a little bit more when there's certainty out there. But the change that we just saw in mortgage rates over the last year, like to think that now we're going to go from 4 to 3.5 or 2 in the next year is like super unrealistic in my opinion. It seems like we're at a pretty good, I don't know if this is where mortgage rates bottom out, but it seems like a pretty reasonable range we're at right now.
I agree with you 100% on that. I think we're in a relatively healthy rate environment in terms of where they're priced. Again, if you look back to prior to the pandemic, when things were fairly stable, the economy was in decent shape, there was even a time frame where the Bank of Canada did not change their rate for over 3.5 years. So I don't know that we'll ever get back to an environment that is that stable, that consistent. That would be kind of the dream as far as mortgage rates go. But if you look at today, you're getting 4.25, maybe 4.5 on a 3-year fix, for example, approximately. That's not much higher than where they were, back in 2018 and 2019. So you're right. Mortgage rates aren't too bad. They've come down significantly from when they sort of peaked out at the end of 2023. At that point, people were locking in at 6.3%. So we're down almost, call it 2% from that point. That makes, a big impact on your cash flow on a monthly basis.
Okay, so there was new mortgage rules that were put in at the end of last year before we knew what tariffs and the trade war was going to happen. And there was kind of this there was two sides of it. There was like, this is dumb. Stop allowing people to borrow more money. This will just push up housing prices more. And then there was the other side saying like, listen, realistically, prices are not going to fall. That's going to make enough of a difference. Let's give first-time home buyers a way to get in. And there was a few changes, but the big one was the first-time home buyers can now get longer mortgages, adding that 5 years from 25 years to 30 years, which over the life of the mortgage, they certainly pay more interest. Most first-time home buyers don't own the properties that long, though. My question with all of this is now this has been in place almost over 6 months now. Is any first-time home buyer using this? Like, is anyone taking advantage of this?
Absolutely. I think 30-year amortizations, I'm sure there would be, hard data on this, but, I would think that any new mortgage originate, today, the majority of them are choosing a 30-year amortization, whether they're insured or not. Right. Cash flow is paramount for people. Minimizing your mortgage costs are sort of top of mind for many people. Keep in mind when you extend the amortization out beyond 25 years, there is actually an increase to the CMHC premium or the mortgage insurance premium, typically 0.2%. So that's something to consider. It drives up the premium amount. There's, of course, PST, provincial sales tax on that premium at closing time. So that adds a little bit extra there as well. But again, I think a lot of people are looking at the 30-year amortization today saying, I want the lowest possible payment today, knowing that when things improve a little bit, my cash flow gets better, maybe inflation comes down, I'm not paying more for everything that I need to live my life. I can maybe start to repay that mortgage a little bit faster. I think also depending on your life stage as well. I mean, if you are 20 to 30, you're not as concerned about having a 30-year amortization than perhaps somebody at 50, 55 years of age, right? But yeah, 30-year amortizations are definitely being taken advantage of. I'd love to see the CMHC numbers on that because I'm sure that they would have that in their reporting when they come out with their 2025 annual report.
Yeah, we've had a few clients that I know have done it, but obviously I don't see the numbers like you see on the people actually making these decisions and seeing the mortgages that they're going through with. The title of this video is that getting a mortgage might have become a little bit more difficult. And I want to talk about one specific situation, which I fall in this situation and you fall in this situation. We are self-employed. And many people are self-employed, and you have to be somewhat creative in your ways of getting mortgages. And for me, it's always like it used to be, at least for self-employed, you need 2 years proof to get qualified without needing someone to guarantor the mortgage. Walk me through today in 2025, newly self-employed. I just started my business. I got out of the job I hated for the last 10 years, but I want to buy a house. What do those people need to know?
So I will say that to qualify at a bank, you do need that 2-year track record. And by 2-year track record, it means whether you're a sole proprietor or you've set up a corporation, that you have filed 2 consecutive years of income taxes, personal income taxes, as a self-employed business owner. Okay. So that is sort of the bank and what we call A lenders. So that's where you would probably get the better terms, better rates. If you've just started your business in the last few months, there's lenders out there that will take as little as 3 months of your business bank statements and create what's called a stated income based on your deposits. So it would help if you have invoices or if you have a contract, if you're a consultant, for example, or, put it this way, any income, any documentation you have to help build that income and paint a picture in terms of what your cash flow is going to be. Now, the greater length of time you have as a business owner, the better. It opens some more doors. It does give you access to better interest rates. I mean, the sweet spot is probably going to be around 9 months, perhaps 12 months of business bank statements. So half the amount of time you would need to qualify at a bank, you can go to another lender where they've got these stated income programs and the rates aren't that much higher. You maybe pay an extra 0.5, 0.6, 0.7%. There are fees involved. So typically it's 1% of the mortgage amount. And the strategy with this, ideally, and it's something that you want to, as a business owner, engage your accountant into the conversation, is that if you are self-employed today and we give you a mortgage where you've only got the 12-month history, we're not going to lock you in for 5 years. We're ideally going to give you a 1, 2, maybe even at the longest a 3-year term, so that fast forward into the future, now you do have that 2-year track record. Do we now approach a bank and move your mortgage over there to give you better terms, better interest rates? Obviously, doing that means you would need the income to qualify under their rules. And so this is where the accountant, would come in and be able to say, if you do claim that higher income, this is the tax exposure that you would have, and compare that to potential interest rate savings. In my experience, most business owners will stay with the lender that they are with and not start to pay themselves a larger income, therefore paying more income taxes. But there are definitely options out there. So, if you left your job and you started a business 6, 9, 12 months ago, just know there are definitely options out there, and it's worth taking a look at what those options are for you. There's a number of lenders that offer some really great stated income programs.
Sounds like a really good solution to what we had been hearing. There's lots of news articles about this, that if you're self-employed, it just became a lot harder to get a mortgage with the big banks. So I know that the 2 years has always kind of been a thing. What did they tighten up at the big banks to make it tougher for self-employed people? They're just wanting more information or more time? Like, what happened?
Yeah, well, the way that banks will look at your income as a business owner is using a conservative lens, if you will. So if you are a sole proprietor, for example, you're going to claim a gross income and a net income. Typically, banks will look at your net income. And that's after deductions, after expenses. There may be some stuff in there that could be added back or whatever, but it's not really a true representation of your overall income. if you have money sheltered in a corporation, there are some bank programs that do allow them to take a look at that. But again, banks are looking at you as the home buyer, homeowner. They're not looking at your corporation as the home buyer or homeowner, even though in reality, it is the representation of your income. And so, yeah, it's just their lens is taking the most conservative approach that they can. Some banks do have stated income programs. Again, they're a little more rigid than what you may find elsewhere. For example, there's some lenders out there where their total debt service ratios, and this is getting sort of nitty gritty, but they're a lot more flexible than they are at the banks. And so that's another thing that we can take a look at for business owners is if you don't fit that bank sort of profile, or if the bank approves you for a certain amount and you need more than that and you are comfortable paying that higher payment, well, there are options out there. It just comes down to being able to show that cash flow. Yeah.
Really interesting. There was a video we had done this channel not too long ago now about why Canadians were breaking their mortgages, and it made a lot of sense. I don't even know if I've told you my most recent story. I didn't do anything yet, but totally got screwed overnight because the interest rate differential and the posted rate, it tripled my penalty overnight. So I didn't do it, and I'm not very happy with them. But anyways, is it too far gone now? Did rates drop too much that all the banks smartened up and they're like, we're not letting this loophole exist anymore?
Yeah, so it was long overdue that posted rates had to come down. They stayed elevated for a while. And to your point, when posted rates come down, it has a direct impact on your interest rate differential, which is the breakage fee as it relates to fixed mortgage terms. And it can, and it does increase what that breakage fee is. And then it's just a matter of, what are the numbers? But of course, you don't want to be told one fee and then overnight it doubles or triples in your case. That's a tough pill to swallow.
Mine went from 7,000 to 28,000 overnight. And I was like, well, this is just a waste of everybody's time now. What are we doing?
Right. Yeah. So it can happen. And I think that, rates need to come down a heck of a lot more to now offset those breakage fees. So maybe in 12 months it does, but for now, and it can also be somewhat of a tactic, right? It's a way for lenders to keep the mortgage on the books. If the breakage fee is greater than what your interest savings would be if you were to refinance and even stay with them, of course, they want to charge you the higher interest rate. But if you're getting a lower rate somewhere else, it makes it prohibitive if the penalty jumps up too much. So definitely something you want to have that calculation run and make that comparison.
Tell you, my experience was I will be leaving the bank I'm with because they do this to me, and I'll be calling you not too soon to start that process in the future when it makes sense. Because I've said this many times, lots of wonderful people that work at the bank used to work at a big bank, but at the end of the day, they are a revenue model, and that they don't really, this sounds bad to say that they don't care about you, but at the end of the day, the people you're dealing with aren't making the decisions from the top that are impacting you. And
right.
I think
and it's transactional.
It is.
You work at a bank and you have targets that you have to hit on a weekly, monthly, yearly basis. And so one way to do that is, by doing these transactions, and it does take away from the personal aspect of it. You're looking at it as a one and done, whereas, there's other options out there where they look at it more through a relationship type of thing to make sure, again, my whole thing is, listen, let's make things work for you today. But I want to make sure that 3, 4, or 5 years from now, when something happens in your life, we can account for that, or at least put some planning in place to make sure that when that event does happen, things play out well and that's just not something you're going to find at a transactional based business.
Okay. So I want to know, people that are still watching at this point, let us know in the comments questions that you have for Jesse about everything that's going on with mortgage rates. Cause this is changing on a day by day, week by week, month by month basis, really. And we've seen how much this has changed in the last year. Jesse, I appreciate you chatting with me again today. Thank you, everybody, for watching this episode, and we'll talk to you soon.
Thank you, Tom.